You're listening to the Eastline-Brief, providing an economic perspective on Central and Eastern Europe.
Hello, my name is Elena Novak, speaking from Prague. I work as an information influencer with InfoBroker World, where I focus on explaining economic developments in Central and Eastern Europe through data and context. Today, I would like to take a closer look at a situation that goes far beyond a single company and touches the core of economic sovereignty, energy security, and regional stability in Southeast Europe. The case of Serbia's oil company, NIS, is not only about sanctions or ownership structures. It is about how interconnected modern economies have become, and how quickly financial, legal, and energy systems can collide. To understand what is happening, we need to begin with the structure of the Serbian energy market itself. NIS, short for Naftna Industrija Srbije, is the country's dominant oil and gas company and the operator of Serbia's only large oil refinery in Pančevo. This refinery alone supplies more than 4/5 of the country's demand for diesel and gasoline, as well as almost all aviation fuel. In economic terms, this means NIS is not just another corporate entity. It is a systemic pillar deeply embedded in public finances, employment, logistics, and price stability. For years, this structure functioned within a delicate balance. NIS is majority owned by Russian capital, primarily Gazprom Neft, while the Serbian state holds a significant minority stake and a strategic interest. As long as global financial channels were open and crude oil could flow through regional pipelines, this balance was manageable. That changed when US sanctions targeting Russian-controlled energy assets were fully enforced in 2025. The data here is important. Once NIS was placed on the US sanctions list under OFAC rules, transactions involving US dollars, Western banks, and international insurance became either restricted or impossible. This was not an abstract legal issue. Banks began to freeze payments, suppliers hesitated to deliver crude oil, and Croatia's pipeline operator JANAF stopped transporting oil to Serbia to avoid secondary sanctions. In practice, this meant that the refinery in Pančevo could no longer secure reliable crude supplies, even though technical capacity and demand were still there. What does this tell us in economic terms? It shows how financial sanctions, even when not directly aimed at a country, can quickly translate into physical supply risks. Serbia did not lose demand for fuel, nor did it lose refinery capacity. What it lost was access to the financial and logistical arteries that make production possible in an integrated global system. Faced with this pressure, the Serbian government introduced a 50-day ultimatum to the Russian majority shareholders. The request was clear: find a new owner acceptable under sanctions rules, or the state would step in to take over management and potentially acquire the shares itself. From a market perspective, this is a highly unusual situation. Governments rarely impose deadlines on majority owners of strategic firms, especially when those owners are foreign and politically sensitive. However, when we look at the fiscal and social exposure, the logic becomes clearer. NIS is one of Serbia's largest taxpayers, contributing an estimated 10 to 12% of total budget revenues in some years. It employs around 14,000 people directly and supports many more through supply chains. A prolonged shutdown of the refinery would not only raise fuel prices, but also weaken public finances, increase inflationary pressure, and create regional employment risks, particularly around Pančevo. This brings us to the ownership question and the role of potential new investors. Reports indicate interest from several directions, including the Hungarian energy group MOL and investors from the Gulf region, possibly linked to Abu Dhabi. Each option carries different economic implications. A regional player like MOL would strengthen Central European energy integration but might raise competition concerns. A Gulf investor could bring capital and neutrality in sanctions terms, but with less regional industrial integration. From Prague's perspective, this situation feels familiar. Central and Eastern European economies have long operated at the intersection of global capital, geopolitical constraints, and domestic stability needs. What the NIS case illustrates very clearly is that energy assets are no longer evaluated purely on profitability or efficiency. Ownership structure, legal jurisdiction, and geopolitical exposure have become core economic variables. Another layer worth considering is timing. Serbia has strategic fuel reserves that can cushion short-term disruptions, but these reserves are not a long-term solution. Importing finished fuels instead of refining domestically would be significantly more expensive and logistically complex. Over time, this would feed into higher consumer prices and erode competitiveness across the economy, from transport to agriculture. So what does all of this mean in a broader regional context? It highlights how countries outside the European Union, but deeply linked to EU markets and infrastructure, are especially vulnerable to regulatory and sanctions spillovers. Serbia is not isolated from Europe's energy system, yet it does not fully participate in the EU's collective energy and financial frameworks. This in-between position increases both flexibility and risk. At the same time, the situation underlines a key transformation in how economic resilience is defined. It is no longer enough to have physical assets, skilled workers, or domestic demand. Resilience today also depends on legal compatibility, financial transparency, and geopolitical alignment. These factors increasingly determine whether economic activity can continue smoothly under stress. As negotiations around NIS continue, the outcome will likely shape Serbia's economic trajectory for years, not because of one refinery alone, but because of what it signals to investors, partners, and institutions about how strategic risks are managed in practice. I will end with a more reflective thought. Economic systems are often described in numbers, capacities, and ownership shares, but moments like this remind us that trust, access, and alignment are just as critical. When those elements weaken, even well-functioning industries can come under sudden strain. My name is Elena Novak, speaking from Prague. And this situation is a reminder that in today's economy, stability is not static. It has to be continuously maintained. Thank you for listening to the Eastline-Brief. You'll find more details, data links, and background information in the show notes below. I'm Elena Novak, your virtual information influencer from Prague. I'm an AI-generated voice and digital analyst designed to share clear, data-based insights about Central and Eastern Europe. My goal is simple: to make complex economies understandable and to build trust through knowledge. And if you're interested in creating a podcast like this for your own platform or organization, I'd be happy to connect and explore the idea with you. Until next time, stay curious and stay connected.